Welcome. I am the options overlord, and this is how to trade the covered call. If you own quality stocks, this is how you put them to work, generating income cycle after cycle on shares you already hold. We do this the disciplined way: education first, premium second, risk managed at every step. Let us get to work. First, the ground rules. Everything here is education, not personalized financial advice. Options carry substantial risk. They are not for everyone, and you can lose money. The data I show is believed reliable, but comes with no guarantee. Do your own research, speak to a licensed advisor, and own your decisions. Good, now let us trade. So what is a covered call? You own at least 100 shares of a quality stock, and you sell one out-of-the-money call against every 100 shares. You collect a premium up front, and you keep it no matter what happens next. In exchange, you cap your upside at the strike. Three things make this work. Your maximum profit is defined. You earn income on top of the stock that you already own, and it is capital efficient because you're not laying out a single extra dollar. Here is the mechanic. 4 steps. 1. Own quality shares. At least 100 of a strong liquid name you are happy to hold. 2. Sell one out-of-the-money call per 100 shares, 7 to 30 days out, and the premium hits your account immediately. 3. Collect that net premium and aim for 2 to 4% roughly on a 30-day cycle. A weekly pays about half that at the same delta. 4. Hold and manage to expiry. If the stock stays below your strike, the call expires worthless. You keep the premium and you sell again. Let us make it real. You own 100 shares of XYZ at $50. You sell the 52.50 call 30 days out for $1.25. That is $125 in your account today, yours to keep. If the stock gets called away at 52.50, you also bank the $2.50 of gain for a maximum profit of $375. Your break-even drops to $48.75. That is about 2.5% on a $5,000 position in a 130-day cycle. Illustrative, not a forecast, but that is the shape of the trade. Look at the payoff and let it sit on screen. Above 52.50, you are at maximum profit, $375, premium plus the gain to the strike. Your break even is $48.75. Your cost basis minus the premium. Below that, you carry the stock down just like any shareholder. The premium softens the blow. It does not stop it. That is the honest truth here. A covered call does not protect you from a real decline. Only owning quality does. At expiration, one of two things happens. Either the stock finishes below the strike, the call expires worthless, you keep every cent of premium, and you sell another. Or it finishes above the strike, your shares are called away at the strike, you keep the premium in full, and your proceeds are the strike plus the premium. Notice this, both outcomes pay you. That is the point. When to use covered calls? When you own at least 100 shares of a strong name. When you are long-term bullish, but expect the stock to drift sideways or slightly down near term. When you want 2 to 4% a cycle on top of your dividends, when volatility is elevated, because fatter IV means a fattier premium, when there is a price you would happily sell at, and when you want to lower your cost basis over time. Tick those boxes and the covered call earns its place. Now the risks, and I want you disciplined here. 1. No extra margin. You already own the shares. 2. The full downside remains. You carry the stock's risk, and premium only cushions it. 3. Your upside is capped. If the stock rips past your strike, that gain is not yours. 4. Assignment and tax. An in-the-money call can be assigned, sometimes early around an ex-dividend date. An assignment is a taxable sale. Tax treatment varies, so get local advice. Respect these and you will not be surprised. 6 best practices. Own quality liquid names in uptrends and skip the speculative stuff. Choose 7 to 30-day expirations where time decay works hardest. Use delta 0.2 to 0.4, about 60 to 80% odds of expiring worthless, with 0.3 as the balanced middle. Sell into elevated volatility. IV rank 30 to 50. Aim for 2 to 4% a cycle, that's over 30 days, and never annualize a single cycle. And roll when delta runs past 80 or when you're in the money 5 days out. Those 6 rules are most of the game. Let us go a level deeper. Delta is 2 things at once: a rough probability of assignment and how much the option moves per dollar of stock. 0.2 to 0.3 is conservative. Around 0.3 is the sweet spot. 0.3 to 0.4 is aggressive, and above 0.4 you are outside the band. On volatility you are a seller here, so you want IV elevated. IV rank 30 to 50 is the working band. Below 30, the premium is too thin for the risk. Same stock, same delta. At IV rank 20, you wait. At IV rank 42, you sell. Managing the trade, the 50% rule. Once the option has lost half its value, buy it back. If you sold for $1.25 and now it's 62 cents, close it, bank the gain, and free your capital. You lock in most of the win, cut your reversal risk, and compound faster. Then decide. Hold to expiry if the stock is safely below the strike. Roll if it is threatening your strike and you can roll out for a credit. Or accept assignment if you have it hit a price you are happy to sell at. Have the plan before you need it. Rolling a threatened call. 3 moves. Roll up to a higher strike for more room. Roll out to a later date for more premium and time. Or roll up and out for both. Here is your example. Your 52.50 call is threatened with the stock at 52. You close it 30 days out for $1.80 debit, and you open the 55 call 60 days out for $1.90 credit. Net a 10-cent credit, $2.50 more upside, and 30 more days. You got paid to improve your position. 6 mistakes to avoid. Do not write calls on stocks you do not want to lose. Do not pick strikes hugging the price. That is begging for early assignment. Do not ignore volatility. Check IV rank first. Do not freeze when a call goes deep in the money. Roll proactively. Do not sell into earnings. A gap can blow past your strike. And do not overwrite. Covering every share leaves you nothing for a rally. Avoid these 6 and you are ahead of the most. A quick glossary so the language is second nature. Covered call, strike premium, premium assignment, time decay, implied volatility, delta, and rolling. Pause here if you want to look back on these. As the seller, remember the 2 that matter most. Theta works for you. Time decay erodes the call you sold. And you want the stock to stay below your strike. So master the covered call. You generate income with clearly defined obligations. You lower your cost basis on quality stocks you want to own, and you compound that premium across cycle after cycle. That is the discipline. Educate, discipline, execute. If this helped, here is where to go next. Watch the world strategy, the natural next step after covered calls. Go deeper in the Overlord's covered call playbook. The full course, 3 stages, 9 steps, and use code YT100 for $100 off. And stay current with the weekly US market updates every weekend. Thank you and good luck with your trading. I am the Options Overlord. Educate, discipline, execute.